On today's docket, the usual dollar, euro, pound analyses, gold, silver, copper, soybean oil, crude oil, stock indices, and Bitcoin. If you'd like to see others again, leave a comment and I'll be happy to include additional assets in our analysis. Man, what a week last week. Let me know in the comments which of the many shorts that we called you caught and how far you're able to take it. I think we'll see continued short bias on pretty much everything that we looked at in the last week as we watched dollar surge. And I've changed my narrative a bit on the metals from last week, so we're still bearish, of course, but I wanted to see a bit more of a pop that I didn't get last week, so I really didn't have much in the way of metals positioning this week. And indices shorts are definitely still playing, and we'll see where we go. Okay, so on the dollar, this is what we had outlined last week. We wanted to see the 382 tapped before we got that last Friday, and then we just took off. So all these deeper retracement scenarios definitely did not happen, which is completely fine. We were expecting bearishness on the euro, bullishness on the dollar, so I don't even think we got this little wick down. Yeah, we didn't. We just had that mini wick, and then we took off. So that was, not unexpected. It's kind of what we wanted to see. We were ready to be short euro, pound, and long the dollar. So that is a good start to the week. We're ready to pretty much exit this whole range. So I'm going to give a daily context here, and then we can zoom out and really look at from a 3-month and even a year time frame, where our targets might be here, because there's a couple ways we can measure this, and they're pretty significant moves here for the dollar, which, if this is to continue, which it sure looks like it will, then we have some good range extensions that we can look at. So on the daily, though, if we take this consolidation from April through May, right, that's basically the Q2, and then here we are in June, we're ready to take off and manipulate this entire range from the last 2 months. So possible extensions on that, there's one standard deviation here at 101,463, but for me, a more likely target here is 2 standard deviations, which is right in the middle of this fair value gap, which we'll see on a higher time frame chart. So, and it also puts us into premium of 2 separate dealing ranges that we will look at on a higher time frame. So that's where I'm thinking dollars at least going up to the middle of this fair value gap, the consequent encroachment of this fair value gap. And I'd be shocked if it didn't quite get that high, because we're not even in premium of either of the parent dealing ranges here. So where dollar is concerned, we may or may not get a retracement into here before we just continue this pump higher. Even latest news, Iran and the United States are exchanging strikes now. So yeah, it didn't look good for peace anyway, but we'll see how this plays out. Either way, the chart is showing us that the dollar is ready to go. We have now taken this sell side imbalance and inverted it over here. So that says to me we're not really looking at too much of a retracement here before we just continue to pump. This whole year-long consolidation is essentially ready to explode. So we are probably not looking at too much of a retracement. Even if there was to be one, you could safely put a stop below this low that was made last Friday, and I think you'd be completely fine. Okay, it may sound a bit crazy here, but we're out on a 12-month time frame, an annual time frame, and I just want to show you this. So we have this overarching yearly dealing range, right? And I want to point out that this fair value gap that got inverted, right, where we ended up tapping out on that was right at the 25, the upper quadrant, the 25% dealing range, and then within this more recent smaller dealing range, also capped out at the 25%, which is why we are, for the longer term, bearish the dollar. But for the short term, we need to get back, don't need to. We are looking likely that we're getting back into premium here before we take a big dump into discount and clear out all these sell stops. This is a yearly basis, so this is going to be a while, which is why on a lower time frame, even 6 or 3 months, we're looking bullish on the dollar for the near term. But overall, on an annual basis, I expect this candle to wick up and possibly close red, or it might just wick up and close green back where we are now, and then we can see another next year a wick up and a big down candle for the dollar to come attack these. But again, this could take 2 to 3 years, but high macro time frame, that's where we are. We've rejected exactly at the 3/4 top of the super premium of this annual dealing range and also the last 5 years dealing range. So we're just trying to eke back into premium here, before we take another dump. Here's a look at the semi-annual 6-month time frame, so the same dealing ranges. And we can note, right, that there's still not an actual fair value gap here that we can see, but there will be one on the lower time frames. What you do notice, right, is we're still below premium of this dealing range, and we have just, we're still in premium of the overarching dealing range. We nicked the 75, the lowest discount with this wick right here. And with this wick right here, we just nicked the bottom super discount of the last 5 years of the dollar dealing range. So we basically hit super discount. We're going to go back into premium and hopefully take a dump from there. On a 3-month chart, right? So this is where I have now outlined this fair value gap, which overlaps with this buy side imbalance. So on the sell side, we have this imbalance, and when we stretch that out, we'll see that a couple of the standard deviation extensions from this consolidation put us smack in the middle of that range. There's a possibility that we go higher, and we can look at that right now. But again, the 25%, the super premium has been shot through and rejected, and then exactly a rejection there from the most recent 5-year dealing range. Okay, here zooming in still to the monthly chart, right? So we've started this push up in June. Here's the range of the entire consolidation on this monthly chart. So the annual consolidation is this range, and a 1 standard deviation higher would put us at 105,735, which would put us in the middle of this premium imbalance and sort of towards the top of this consolidation. So, it's not impossible that we get up there if we do take a fib on this smaller dealing range from here to here, right? That would put us almost to the ultra premium of the last 2 years dealing range if we were to get up to the 1 standard from this consolidation. If we consolidate here and we push up 1 standard deviation to then reject, that would put us just below the super premium, and a wick might shoot up there, but it would be definitely in premium here and above even the 618. Again, premium here is right at the, in the middle of this imbalance, and also just below the consolidation that we see here. So to maintain the more bearish case on the dollar after we've taken some of this buy side liquidity here would be to kind of hit this 3-month inversion fair value gap, which rests basically right at the midpoint of this consolidation, and then we can take off. So we may not need to hit this super premium inverted fair value gap that ran the liquidity of this consolidation. It's possible that we don't stretch that high and tap into that 1 standard, but it's also quite logical and possible that a 1 standard deviation move of this entire range would take us up to here within this sell side imbalance. So that's certainly possible. Again, we're looking at a couple months out, but more likely this first target is almost the for sure thing to get into this 3-month fair value gap into premium of both this dealing range from the last 5 years and then the last 2 years of this dealing range. We would get into premium at both of them at this level, and there's a nice inverted fair value gap up in that zone, which also aligns with the bottom of this bullish candle, which was part of the liquidating raid on this whole buy side liquidity here. So it would make sense for price to want to rebalance into premium to tap what was a breaker block coming out of this consolidation. Zooming in just once more onto the weekly time frame. So the last 2 months of consolidation here, if we measure that dealing range and project up 1, we're still in discount of both ranges here. So expect to see at least 1 standard. 2 standards puts us dead in the center of that 3-month fair value gap that we saw from the higher time frame. So that to me is almost a surefire target, which puts us right at the bottom of this wick from this candle, and again into some of this breaker blocks, not even premium of the breaker block, right? We could go up to this if we took that whole range from the last year and we went up to 1 standard, right? That puts us pretty darn close to the bottom of the actual block that rated the entire liquidity of that consolidation prior, right? So this, it did sweep it here and then looked like it was going to reject, and then we really shot through and rejected. So this is the beginning of that breaker block that we then displaced through that low. So it's possible that this 1 standard deviation from this entire range goes up to here and mitigates the order block there that completely took out the rest of this liquidity into this sell side imbalance. So that's what I'm seeing on the dollar as far as potential targets over the next month, two. Maybe in Q3 we start to see a little slowdown consolidation somewhere between here 2 and 3 standards, and or this 1 standard from the entire year consolidation range up to here, and then we're back in this 12-month fair value gap on the discount side of it, right? So if we were to grade that range as well, this 1 standard is pretty close to 1/4 of that entire range, almost to the tick, right? So that again is not improbable, right, for the dollar to reach all the way up to the lowest quadrant of this fair value gap from the last 7 years or last 5 years, and look at this imbalance and mitigate this breaker. So to me, that would be the ultimate target for the dollar on the upside, and then we should be seeing a dump. I know it's a lot of fibs, or it's not really fibs, they're just range measurements for dealing range, and when they start to align like that, it really gives conviction to the narrative that we're making. Final word, again, we're looking at weekly, daily, 3-month, annual timelines here, so high time frame analysis, top down. This can take a while, and we need to just be patient. And I know we're not all position traders, swing traders, whatever. You may have your own entry models to get in here wherever you want to get in. Short euro, short pound. You don't really long the dollar itself, but just be patient and know that this is going to take a while to play out. Even though last week looked strong, we are still in this range, right? Again, 2 weeks ago we were saying, we have a long way to go, right? This is just the push out of this range. Then we will likely retest it and then take the real swing higher. So again, we're just getting started, and I know there was a lot of activity last Friday with NFP. I was completely beside myself for not being in more positions short that I knew were coming, and I just thought a few higher levels were going to get hit, and they didn't, but we'll get more to that later. So for that being said, there's still plenty of room to run here. There's plenty of opportunity on the lower time frames to get in sync with this. So be patient, find your own setups that you know will work for you. As far as a logical 4-hour entry point on the dollar, I'd want to see a retracement to tap the premium of this inversion fair value gap at least. It may not do that, right? So the dollar could just completely take off. Ideally, I want to see something that would put us, just into this fair value gap at least, right? And preferably for a better entry down to this upper, the upper premium quadrant, which almost knocks us into this high, right? It's just above this recent high of this consolidation here, but grading this fair value gap from over here on the way down, and now we have balanced it out and we're on our way up. We could just tap the entire top of the range and then take off, which would liquidate this last 4-hour candle from Friday. We could see more of a rebalancing in here down to 75%, the upper quadrant here. If we got to 618, that would be pretty deep in my opinion for what we saw, right? So NFP, we exploded higher. I'm anticipating just a retracement at most to the 75, if not just simply the top of this balanced price range that we are now leaving, and off to the races. If we look at Euro, quick recap of last week, right? We wanted to see a little bit of a push, a dump, a retest, and complete flush, and that's basically what we got. So these two, it did not get into a super premium. It had tapped the premium last week, Friday, and rejected, and we didn't even get much of a retracement up. We gapped down, closed the gap, right? So we gapped down, we just touched the top of that gap with these bodies in here, and just flushed the rest of the week waiting for NFP to completely liquidate everything and start to balance this price range now. So we had this imbalance on the upside. We consolidated within that imbalance for quite some time. and now we are exiting, which was a nice fat move. Again, if we're going to look at entries on the euro, I think we can be looking at a retracement possibly to the bottom of this range. Again, that would be the top of that range on DXY. So that would be really as far as I'd want to see it come on the euro before we just continue to take liquidity to the downside. So we are leaving this range. Again, if we zoom out to the daily, this liquidity has been in question for a while, and we are getting there. So this entire range from here to here, we have now displaced through the 25% mark, which is exactly what we wanted to see, right? We saw resistance here at the 50, we closed below it, and we had this run down consolidated right around the third, and we again nicked the quarter back up into premium of this dealing range and flush. So again, for euro, we're in second stage distribution. It may not even get a retracement next week, but just be on the lookout for your particular setup on a 1 hour time frame or so. There is again the possibility that we just continue this as rapid as this was, and where we closed, we could gap down and just keep going. That's not out of the question. So for me, this is the hardest time. If I wasn't in yet, and I got scared out of my euro short back here, and I'm very upset about that, but I really haven't touched it with this consolidation. And I just saw this candle and was like, I'm not in this move, and that has to be okay. But now how do I get in? This is what I'm the worst at, is once I've analyzed the move and then it happens without me and I know it's going to keep going, where can I get in here that makes sense without taking on a huge amount of risk? And that's position sizing for you. If you're now we all know where to be on side. We're going to be short euro, right? If we get anywhere above halfway of this candle, that is a clear short, and you can place your risk above this candle, especially this green candle, because that's going to be the order block that sends it lower. You're most likely safe even just above this candle, possibly even halfway above these wicks, where this consolidation, we should never get back into the premium of this consolidation. So you're probably also safe with a stop into these wicks just above the halfway point. So if you want a position size for something, the deeper we retrace into here, the bigger position size you can take with that risk level. If you're to model a short position, say from here, and you want to risk just up to there, right? Then you can use the tool to come up with your scenario of how much you can put on in size for that amount of risk. So that's, again, I leave that to you. But as we've been calling shorts on the euro for 3-4 weeks now, I hope we can get a retracement to get a good entry here. On the pound daily, we thought if we wanted to get an ultra premium, that was this scenario. Obviously didn't happen, so pound played out exactly to script. We did take some buy side liquidity with a manipulation up. We closed. We did not get below this candle, as we said. Compared to euro, pound is a bit stronger, so I wouldn't be surprised if that initial pump did not break this candle's low, and it did not. And then we did get all the way back up just to tap this weekly gap one more time before the ultimate flush. So there was a nice divergence between euro and pound here. Euro did not make this high to take the previous 3 days liquidity, whereas pound did, and off to the races, down. So pound played out exactly to script. If you were in it short and you got wicked out here, don't know what to tell you. That's how the cookie crumbles sometimes. And I'm just upset that I missed the entire move on the Forex, futures contracts for the 6B, 6E, or even in the CFDs where you can trade the actual Forex. So yeah, I'm just upset I wasn't in this at all, futures or Forex wise. That's just how it goes. You can't pay attention to everything all the time. Okay, so on a 4-hour basis then, as far as entries on the pound, if we are now to start this as the new dealing range, but within what we have from this low and within this bullish imbalance that we are going to invert, the best possible scenario, I think, for me is that we get into a premium of what we made last week. which would be all the way up to here. But when you look at these bodies right here and where that fair value gap aligns, I'm thinking we just tap the premium of that before we take off. And again, this is kind of best case scenario, right? If what we've done on Friday, it's possible that we don't get a retracement. We might even gap below this low, and here's the lowest quadrant of the dealing range, so we should be displacing through that next week with the pound, right? We kind of launched from it to make the top of this dealing range, and when we're going to liquidate down here, we should be getting a displacement through this lowest quadrant of the dealing range. So we could gap down, maybe react, and then displace. We could possibly get a move up to manipulate and then displace, but we want to see a nice red candle breaking through this 25% mark on the way down. But either way, again, I think you can also look at your short positions here from, assuming that you're going to take on this much risk. I doubt we're taking last week's high with how it manipulated. Then, this is a minimum position of a 2-hour trade, right? And if you want to take something a bit longer, right, we could certainly be looking at a 2 standard extension of just what we have here, or even, we're going south. So there's a long way to go. We have these lows as well, so that would certainly be a logical target for the coming week or two. So yeah, this is a 3.6-hour trade. If you were to take it at the top of this weekly, or top of this 4-hour imbalance, and take it all the way down to the 130, 3.6-hour, not bad, and that's actually a sizable amount of risk. So if you wanted to try something, a bit on the cheaper side and get more of an 8-hour trade style, you could look at putting a stop above this wick. But there's a chance we retest that, of course, in the midpoint of this dealing range, right? We could squeak all the way up to halfway and reject from there. So that would be an ideal short if we liquidate the body. If we are able to liquidate the body of this candle right at the 50% of this dealing range, then that would be a prime opportunity for a pretty solid risk to reward here. So even if you were to take that wick, then we're looking at a 4.6-hour trade down to 130. All right, so I know that was pretty quick on the actual euro and pound, and most the heavy analysis was on the dollar, but that's basically what's going to dictate these two. And now that we've started the on-ramp to the expressway, we're going to keep going. So it's just a matter of how much we retrace, where and when. And it's kind of a light news week with CPI later, so CPI tends to continue a distribution if it's already in play, and that's where we could see 130 on the pound. And what are we looking at on euro here? Down to at least 114 on euro, probably 113.5 is likely. Okay, on the metals. So I wanted to see a bit more of a manipulation to the upside on both gold and silver and copper to some extent, but we just didn't get that at all, and it was a complete flush. So yeah, we were looking bearish, right? We were expecting bearish. I just didn't expect it to be that bearish that quickly, and just, again, we were saying they're lackluster. They did wick, so gold was able to wick into here on Friday and reject. So, honestly, looking back on it, I'm not exactly sure what I was thinking to hope that the metals give us a better short entry way up here into the premium. It really didn't. It just gapped up a little bit, gave a little wick, and then just completely flushed for the rest of the week. So while we were looking short, I wanted to see a bit more of a liquidity grab on something that can be as wicky as gold to actually get up there, but it's just looking really weak. And silver is looking also as weak. I thought this nice flat high could just get wicked, and I really wanted to see it, and it just didn't happen. So on the way to the downside we go, and we're still very bearish metals right now. I have this overarching annual dealing range here, and we've just plowed through the 50% of the annual dealing range. So that is not good for metals bulls. I'm revising my targets for where I'd want to accumulate, because I think in the quarter of this annual dealing range, way down here, I think in the quarter of this annual dealing range at 38.32 is conceivable in the coming months. We're most likely taking this low out. This is on a B adjusted basis. So a couple of things that I want you to note here. This 75% mark of the annual dealing range on an adjusted basis is exactly where we flushed out of this consolidation here. So that's a very strong bearish signal. And then where did we stop? Right here at the 50%. So we've basically consolidated in premium and flush. And this has been the same theme on these two dealing ranges in here, where we consolidate in premium, displace, consolidate in premium, displace, consolidate, and we're still in a slight premium of the annual dealing range and displace. So now we have busted this low with a fat red candle during NFP, and this is now quite a bearish sign that we're probably headed to super discount, which is 38.23, and a low target here in the 32.12s, and that puts us even below this whole consolidation that started this move up to the top here from August of 25. So yeah, basically a year, and we could see this whole market maker sell model come to fruition, where we could be taking out this consolidation. And I know that is dire for a gold standpoint, because if dollar is going to be increasing, we may start to see some decoupling of where, one reason I was bullish a bit the metals in the week. I wanted to see more of manipulation, and I wanted to see more manipulation on the indices, was looking at crude oil, and we'll see that in a bit. But crude oil was just as bearish as everything else last week. So that was one thing that the inverse correlation cracked a bit last week. So that wasn't fun to see or experience and try to get into trades with. But it's what happens, right? So if I turn off B adjust here, and we're still headed for 25% of this dealing range that we have. And, so that's 43.05, taking out this wick. And I'm pretty certain that we're going to be headed towards this low on all the metals, including copper, right? We had this trend line that only got half wicked out to, or probably a quarter of the way here, right? We filled that little gap here. But this is just a very bearish sign for the metals. When we displace through here, we displace through the 50%. So, it's going to be hard to say we're going to get a big wick back into premium here. Switching over to silver. Again, same story. I have another, I as much as I don't want to say it, this whole dealing range from 20 to 120, it's looking ever more possible that we revisit at least 45, which is the super discount of the entire range. If things get really off the cuff and we continue all the way back to 20, that would put a hole in a lot of people's pockets, including mine, where I bought some silver here at 72, and it's physical silver, it's fine, I'm not doing anything about it. I was definitely bullish until really seeing what happened here, and with this last week where we couldn't even get above these equal highs to then displace down. I wanted to see something more that would give us a liquidation of this low before we then could start another leg higher. And now I'm not seeing it until we at least hit this super discount at 45.5. Essentially, I'm going to just get rid of this for right now. If we wanted to project that, I think we could look more at that next week. But for now, right, we're certainly headed down. We've broken the 50% of this annual dealing range, and super discount is likely the next stop in the next several weeks. So probably by August, we're going to be looking here at silver back at 45, which one bank might have been calling that. Bank of America had a target for 60 or 45, something like that. And everyone was saying, no, they're crazy. I was, definitely bullish somewhat, but seeing as the dealing ranges, right, we tapped the super premium here on silver and we displace off of it. And then we, consolidate here with the bodies hanging out mostly at the 50% mark. We were able to get back into premium and knock out some liquidity here, and then completely reject that, consolidate a little bit more in that premium, and displace. So this is a strong sign that we're headed to at least the super discount of the silver dealing range from the last year. And that completely correlates with sort of the broader market narrative that I'm seeing, with dollar rising and oil looks like it's just going to tap its discount range and then take a moonshot. So the things happening geopolitically make this entire narrative make sense, and I won't be buying any more silver or gold in the next several months or next several weeks, probably several months until we start seeing a base here, hopefully at the 25. I'd love to see bodies here with the wicks to take out this consolidation. I'll zoom in for you here. Right, so with this displacement, I'm definitely seeing I won't be buying silver till at least 50, and I'd love to see bodies closing above this 45 level, the 25 level, $45 level, with some wicks to take out this sell side liquidity, and hopefully that's the bottom of silver, and we'll see where gold and copper are at that point. But that's to me the most likely scenario right now, given that we couldn't hold this 50 and saw what we saw on Friday. I think we're headed here with hopefully body closures above it and wicks to take out this liquidity before the run up. So for silver, we're just headed down here, and I'm hoping we can get a reversal at that point, but it's certainly possible that we just keep going and liquidate the bottom of that range, which would be pretty sad. That said, though, for all the hype and headlines that was happening around January, February, it was the perfect story to get plenty of retail involved buying the silver and gold that every institution, smart money, wanted to dump. And for me, I'm thinking, yeah, okay, I'm smart money too. I waited for this here in March to be buying silver below these lows, thinking, okay, cool, I'm smart money. Maybe I'm not as smart as I think, given what I'm seeing now. I didn't put a ton into it, maybe 800 US. And I think that's, it's a reasonable amount. If we are to have a recovery, that's fine. I can certainly withstand a dip here and accumulate more in the 40 zone and the 20 zone, right? Silver is still a finite resource that happens to be a byproduct of most other mining. So with its industrial uses, yeah, everyone was making the case back here that we're running out, that COMEX is going dry, and everyone's causing demand for silver, which was a great narrative to get people to buy. And so I bought some down here at 70, 72, and that's okay. I didn't buy it at 120, and I ultimately think, yeah, we will get back up there because the demand is just going to continue, but from a smart money and a consolidation and a wipeout of all this liquidity perspective, this narrative now makes complete sense, and this is the telltale sign that we're headed towards that way. Copper did almost exactly what we thought. We did take a little bit higher than a failure, and we went into half of this wick, and we are starting this trendline liquidation. So copper is actually I think copper is going to make for a decent understanding of where you can logically take profits here. So you're going to have more lows and things to kind of scale out positions if you are interested in scaling out of positions. Copper is going to give you a bit more of in the range targets to play with, where liquidity is going to be under these lows, liquidity is in this gap, liquidity is under this, right? And we thought last week that it might have been out of the question that copper reaches all the way back down here below these lows. I don't put it out of the question anymore. So these lows we talked about as possibly being protected last week, it could definitely get liquidated. While copper has been the strongest metal certainly in the last several months, it's going to weaken with the others. Just how much is the question. So this low is certainly suspect as part of the dealing range, and these nice flat lows in a discount. If we are to take this dealing range now, this whole dealing range. So these flat lows with a 25% dealing range and an imbalance below it is a nice target for me. So again, with the overall bullish narrative that we had on metals kind of starting a month ago, that has pretty much reversed, and we started to see signs of that. So gold had displaced through its 4-hour 50% dealing range. Silver had done some of that too. Copper, we saw this run up as manipulation and this trend line as something that will be a liquidity provider on the way down. So we have just basically started that run down, and the question is now, where can we get in? If we want to be looking at, so that's daily time frame. If we zoom in on a 4-hour basis, Right, so on copper, yeah, we still have this smooth double top. Even on a B adjusted basis, it's basically the same because the contract was the same. So that, to me, says it's going to get run out sometime later, and it could be a while, but this isn't going to stay here forever, so it does still lend to an overall bullishness on the metals, or at least copper, in my opinion, that, definitely could stay for a while, similar to ES, which I lament ES right now, but ES left a just perfect equal double top on, its last week's chart. And I just wanted to see that liquidity taken before it dumped. Dow certainly did it. NQ barely did it. And I wanted to see ES do it with the rolling flat highs there, but I'll show you that when we get there. It didn't. So yeah, while copper actually did make a bit more of a push, then exactly this little failure swing happened, and we are headed to the downside. So, what I'm looking at for a 4-hour entry here might be something in this zone where we have this bullish imbalance that looks like we took off right from the start of it, so that could be a good entry point if we were able to get back up into there for copper. I'd love to see that as a very, very low risk entry to the short side on a 4-hour time frame. That said, we may not get up there, right? We may just get into this imbalance. Right here, so a couple overlapping imbalances. We have this imbalance, which is the start of this propulsion to the upside that would have taken this consolidation out, not quite breached that high, and then we come back through it. So, if you could see a case for maybe just a tap into that, right? So if you're gonna, is this a repricing candle? No, not quite. Okay. I wouldn't see a repricing into this balanced zone as likely anymore, right? This was the ultimate breaker here, and we already pushed into it and rejected. So this balanced zone, I wouldn't see, while it's in premium here, this would be the last ditch effort to get in short. Otherwise, we're going long, but I don't think so. The metals are as heavy as they are. If we do get some retracement, this would be as high as I'd want to see it go. More than likely, we're just going to tap the bottom of these candles, possibly get into this gap that occurred on the upside where we launched down from. And if we are to zoom out a bit and take a dealing range, we can see exactly where that falls, and I bet you it's going to be at 75%. If we were to mock up the dealing range from this high to this low, and what do you know, 75% is pretty much, it's just above that. So we could get a body close and then a wick or something if we, yeah. And that's just this dealing range, but taking this smaller dealing range, right, that 75 mark was exactly where these gaps are, which is a nice alignment. It's also pretty much exactly where this candle launched from to take that, and we displaced through it. So this was a nice failure swing where we just wicked the body of this down close candle, and we have rejected. So again, this gap at 75%, this dealing range low, is most certainly in play for this week or this coming week and a half, and certainly this super discount target of 60435. So copper analysis went pretty much as planned. We did take a bit more of the upside as silver and gold did not, so we had a divergence there as well, and copper's headed down with the rest of the metals. Okay, crude oil. Crude oil has been a bit tricky, and I think I said that a week or two ago where crude oil has been tricky. On a adjusted basis, right, we wanted to take this low and get into a discount past the 618, so there is this gap here that we wanted to see some tap into. We're not quite there yet, actually, so on the actual, not continuous contract, the current contract, so July contract, right, we have not yet been able to dig into this weekly gap that occurred back here. So I wanted to see more of a bearishness on oil, which was leading me to think that gold, silver, and the indices could make a bigger run up than they did. And quite honestly, when I'm seeing oil as bearish on Thursday and Friday, and I saw also that gold and silver and the indices were bearish too, I mean, everything was just a sell on Thursday or Friday, but Thursday and Friday, everything was a short except the dollar. And so that was one of the things that was still giving me pause, was that the last 2 months, oil and the indices and gold and silver have been completely inversely correlated. And the fact that oil was also closing down on Friday was tantamount to that correlation narrative that's been pretty consistent over the last several weeks. So that wasn't exactly what I wanted to see. If the indices were tanking like they did on Friday and gold and silver were displacing downwards like they were, I wanted to see oil bottoming out earlier or possibly sweeping this low and then taking off to the upside. So we ended up, right, we projected that oil would have some kind of retracement up and then down, and we did end up getting, all the way up to close some bodies here underneath this and close in this gap, which wasn't unquestionable, right? I think we said we might see a take into this high and get into this gap, and I think we wanted to do that the week before, perhaps, but it waited till this week to do it, and so now we're definitely coming down. I do still think that this gap would be an ultimate target to sweep the lows, which lends to some of the narrative that gold, silver, euro, pound should have a retracement into their leg that they saw on Friday. If oil weakens, all those could strengthen a bit, kind of get that correlation back on for the time being. So, that's where that cracking correlation on Thursday, Friday really was confounding many of my entries, because I wasn't seeing oil trying to get to the upside as I wanted to see, while everything else was just taking a trip to the downside. So seeing it close this gap was great, and then I want to see it roll over and get into some of this zone, right, to take some this nice flat lows into the bottom of this gap that hasn't been touched yet on the July contract. And I expect that to happen based on what we're seeing here. This is a market maker sell model where we can certainly body down to the 75 mark and maybe wick the bottom of this gap. So I'm seeing that now as more in play this week than obviously last week, which I wanted to see this. What I wanted to see last week was a slight run up, a big move down here by Thursday, Friday. So for NFP, oil could be shooting up while everything else was dropping like we saw. And we didn't get that. So that's how it goes. You can't have everything correlated perfectly all the time. But now this does lend to the narrative that those other assets may see a early retracement in the week to give some bullishness to euro, pound, etc., while oil just continues to take out this low and dig in here. And then when it turns around, everything else can continue its downward slide. That said, it's certainly possible based on our analyses that we just everything else continues to slide, and it only accelerates when oil bottoms out, and then we start shooting up. So what I'm seeing for oil is a bottom out, and then we're headed for a moonshot. So I'm telling myself, get long oil wherever I pretty much can, because once we get below this low and tapping into the super discount, I just think we're headed to the moon on oil. This low, again, last week we said is probably going to hold on the July contract, while on the continuous contract, it probably won't. Wait, that's this one. Oh, I have it adjusted. On a non-adjusted basis, yeah, I mean, it might still hold, actually. So, yeah, I thought maybe we'd see divergence where this low gets taken on the continuous contract, but at this point I don't see that happening, so that low should hold on both the July and the continuous contract, with a body here to the 75, and this looks like it needs a wick as a repricing candle. I think it's not quite, so the open 88.50, the low 88.45. So there is a slight wick on this candle, but it's likely to get revisited with a wick, hopefully. If not, then we will just see it bounce off the 75 and hopefully to the moon. I mean, not hopefully for our gas bills and pocketbooks, but just from a trading perspective, I see that as the most likely scenario on oil with everything else we're seeing. So dollar and oil up to the moon for now, and everything else down. Right, so for oil on an entry time perspective, I doubt I would try to take this short into the super discount, but it's possible. My bias is going to be long, but I'm not going to be long till we're down here, and I do think for the time being, we are short below this low, below these relative equal lows, and into the super discount. But if I want to just take my long bias, I'm waiting until I see, 1 hour displacement to the upside, and then I'll look to enter on a retest of that level. So I'd love to see a turnaround right here to then make that bullish case for the long side on crude. Soybeans, soybeans, soybeans. Who caught this short that we called it directly? We said we're gonna tank, and it did. So on my part, I caught from about 118 down to this low. I caught half of that, so I was pleased with that. But I wanted to just hold it, but I didn't. I wanted to get out at this logical 1 standard mark from what we had measured of a dealing range up here. So, that's how it goes. I still project that we're headed down here to the super discount of soybeans, but if you caught this, please leave a comment. Let me know that you were in this soybean move to the downside. I was in it. I exited just a little bit earlier than my target. Well, a lot earlier than my target, halfway, thinking maybe I could re-enter on a push up. I still have my limit order in that I can't cancel. It's like up here, and there's no way we're getting back in up there. So I think I'm out of this move for now until we maybe consolidate here and then have another run to the upside. So soybeans, yeah, this trend line held with a fake out, which is what we explained last week. This was a fake out and then a complete breakdown. All this was going to get wiped out, and it completely did. The question is how much farther. We definitely displaced below the 50, so that tells me that the 25% is certainly game. And again, we're going to meet up with this fancy dancy trend line that's coming up here into the discount of this dealing range and this super discount of this dealing range, smacking the trend line. So do we continue to go down? I doubt it. It's possible we break this, maybe sweep this lower dealing range and come back up and then go, because if crude oil is going to go up, then the price of soybeans, soybean oil, and things are also probably going to go up. So this narrative still matches with the correlated asset of crude oil, where we would continue to come down as crude takes that low. We get into a super discount here into this balanced price range, and then we can again look to long the soybeans back to clear this double top. Soybean oil is looking exactly like what we thought last week, so this trend line is still barely broken. And again, similar to copper, soybean oil has been much more of a bullish scenario here on the commodities, and we could see a bit more understanding of liquidity pools on the way down here, where copper, again, you could see exactly where you'd want to be taking any partials if you're short. Again, soybean oil, though, on a daily basis only capped this high, and these highs are still in question up here. So if we do get more of this would be a bullish trend line fake out on the soybean oil side of things. We should definitely be taking this low and probably into this gap, right? So if this dealing range, we'll draw that in a second, we should be getting down to maybe around here, and we'll see how this plays out in the week, but then maybe back up here. Soybean oil itself is not completely correlated with soybeans, but we may end up doing something like that once we clear those all-time highs back there. But on a dealing range perspective, right, if we are here, then certainly below the 75, and that's this dealing range. This is at the 50 mark, so this ultimately could get a full market maker sell model liquidation if it's going to follow along with stock indices, for example. On a smaller dealing range perspective like this, here, let's do this one, right? Then we could look at a tap of the 75 to wick the top all-time high and then down. So I'm looking to at least 69.10 for soybean oil to cause a fake breakout of this trend line with the possible retest, tap of the all-time highs to sweep, and then come down. So soybeans, kind of a similar story. We could be looking at up, and that would follow the soybeans up, and then we'll see where we are once both of them take their highs. Okay, indices. So if you weren't in this short, then you probably missed a big quarterly opportunity there, but unfortunately I missed it because I wanted to see this relatively flat equal high taken first, and it happened on Dow, it happened on NQ, and it did not happen on ES, and I just blew it. So anyway, that happens, and while I've been putting this short and waiting for it to go a day like this, I missed it. And I can't believe it, but that's how it goes sometimes. The cookie crumbles. When I was seeing in oil going down too, I wanted to be seeing the indices rising as an inversely correlated asset just that little bit more before this happened. That's the life of the trader. You're not in every move, even if you forecast it. So again, as I said in the beginning, if the analysis helped you capture any portion of this move in any fashion at all, more power to you, and that's why I'm doing this. So even if I miss it, someone else here can benefit from this kind of a move, because I was telling my wife this should have been a $20,000 day for me, and instead I walked away with basically nothing. So, that's how the cookie crumbles. We hit exactly the 25% of this dealing range that I drew. I want to see 77.10. Does that mean it has to happen? No. But again, I made the case last week for this being the valid dealing range, or all the way up to 77.10. The fib that I redrew here to this 5 standard deviations at 76.44 is kind of where we tapped out. Not quite. So we didn't even get to 5 standards there. This is almost a repricing candle with its high only 50 cents higher than the open. And I just have this suspicion that we may plow through this one more time to 77.10 and then down. That said, I continue to only look for shorts on the indices. NQ, same thing really. I mean, it did not get all the way up to the 4 standards at 30,852.75 or the 30,855 that I had drawn, which is, this one got basically as close as you're going to get. So that's where I'm not thinking that ES is going to get back up there and make the 77.10 mark, right? This is the dealing range. ES was the one that, while on a 30-minute time frame, this garbage I thought was going to get run out, and these are nearly the same price. So to leave this kind of a smooth double top as it had on all the way up, as I mentioned last week, kept leaving relative equal highs, kept leaving relative equal highs, back up here, kept leaving relative equal highs. So it was still textbook for ES to leave relative equal highs, run it out one more time, which I thought this run was going to do to 70. It didn't even have to get to 77.10. I wanted this to get run out and then NFP to blast through everything like it did. But ES just didn't have the oomph to get there. And what I should have seen was actually that the body's capped out right here, and it completely dumped after that. There was, I think on the regular trading hours, ES didn't even clear this, but if you look at NQ, this should have been the absolute clue on the regular trading hours that we basically just wicked in to close that body, and then we started to tumble Thursday afternoon. So that was that, all the clues were there to just get in short wherever you wanted and not even think twice. But I just kept seeing oil go down, and I wanted to see some kind of fill within this gap, or I just wanted to see something of a better entry that I never got. And so I hope many of you were able to catch this fat short on all the indices last week. The Dow actually wasn't as horrible looking as all the rest of them. The Dow did end up taking, its all-time high on Friday, which was a nice sign of divergence. I said I wanted to be short at 51.5. It got all the way to 51.851 or so. So again, that went farther than I wanted to see it go. While ES and NASDAQ didn't make it quite as far as I wanted to see them go, which was kind of why I just had to stay out. I wasn't seeing everything that I wanted to see line up, even though I've been putting these short for the last 2 to 3 weeks and calling on those dealing ranges as we have them on ES and NQ. So again, this is a beautiful move if you want to see that. This is a beautiful move if you've been bearish and NFP hits and you just want to ride this all the way to the close. Some of you may have seen that really funky looking wick that occurred on ES earlier in the week, I think. You can't see it now, of course. TradingView is taking it off, but one of these candles in here showed this entire wick all the way down to here. And it just, this huge wick, and it went away after about I don't know, 4 to 6 hours, someone called someone, I'm sure, and said, hey, this needs to disappear, because that's exactly what happened on the NFP Friday data release. So, you know, some people on Twitter have said that is a quote-unquote glitch that, you know, can be exploited. And for sure, I mean, if you've seen it before and that happens, this was still expected. It doesn't really matter whether TradingView and some kind of data leak happened to show up on the chart in time, right? This is exactly a measured move of ES from its top. If you've followed for the last couple weeks, you were ready to take a short somewhere up in this vicinity, and we should have only been looking for shorts, and there it really delivered. So if you caught this, please also leave a comment with how much of it you were able to catch, because that's what we're trying to do here, is be able to analyze and give the right setups for folks on this channel. All right. As far as what to do now for ES, right, and all the indices in general, this is just the beginning. Again, it's kind of like we said it for the dollar. The dollar is just beginning to leave the range, so ES and NQ and Dow are, in my opinion, just beginning to chew back through this entire run-up that we had. And, you know, so this is 25% of that range. I missed it. If you missed it, it's okay. There's going to be other opportunities to get short the indices all the way to at least discount here, minimally, right? That's the top of this consolidation. But if you are of the opinion like me that stocks at this point in the US economy are completely overvalued, and the technical reasons for this being a long-term top, maybe I'd say 5-year top here on the indices, with, you know, the way things are going geopolitically, with the way other assets are behaving, that there's no particular reason to be long-term invested in the US stock market, in my opinion, at this point. I liquidated most in February here, thinking I don't want to see a 30% downturn when I could sacrifice another 8 to 10% on the upside, which is basically what's happened now. And I'm seeing this on a weekly, monthly basis, right? From an ES perspective, I see this gap and I see these highs as where we would ultimately be targeting. So this as a manipulation of all this consolidation. So we break down, we have a fat UTAD here, upthrust after distribution. So this was a distribution. Market makers knocked us out at 4 standard deviations up, and we will finish this dealing range with a liquidation down to this imbalance here on the weekly time frame. So this is, and it's also a big imbalance on the monthly time frame. So that's the analysis on ES. Again, if we are to draw a funky dunky trend line like this, right? Who knows, right? But this, you know, if you're to take something like this, which is silly, but on a monthly time frame, why can we draw a trend line? Because it holds at certain points throughout, right? And if we are going to have a 1, 2, 3, 4th tap of this, if you look at most trend lines, I mean, again, they have some purpose because retail sees them. If you look at most trend lines, a 4th tap doesn't tend to hold, and we could be looking at a complete devastation of the U.S. equity markets all the way down to this consolidation if it were to get really bad. I don't need to spell doom and gloom, but this is certainly, for me, a top for the next, you know, if we're measuring in months, and we're going to come down for 1, 2, 3, 4, 5 months, so the rest of the year, we could be somewhere down here hitting the trend line, and then the question is, do we break out downwards, have a retest, and continue? Do we false breakout, come back above, and keep going? I don't know. ES has so far left this flat top, which ultimately should get run out because stocks are going to go up. It's just a matter of how far it's going to come down into discount before people are willing to reaccumulate and head up. So on a weekly basis, stocks are at least to the trend line, if not completely blowing out this low and into this imbalance and this consolidation here. So I'd say target 2 and target 3 is to liquidate this low before we would then actually start to see a recovery. So that, you know, is a long time. I think that if you're going to look at 2029 as a return to this, so we'll have a big market maker buy model here, is my forecast for the stock indices. NASDAQ itself, again, AI is not paying for itself anytime soon from my perspective. So we could see NASDAQ taking out these lows or into this consolidation where, you know, ES or NASDAQ may leave these lows intact. But again, there is an imbalance below them. They are relatively equal and smooth, along with this too. And is this out of the question? Not particularly. When we look at Bitcoin, when we look at, again, where gold and silver might possibly start to, again, diverge with the indices, where I'd like to see gold and silver bottom out and then start to become more of the store of value that they usually are, and return to a bullish sentiment where the stocks can actually take just a massive tumble. So I am only short one micro ES contract, and I have some put options in the SPY right now. So I'm short one micro ES from basically where we are now, because I front ran it. I did not quite get in on the top here, but I front ran the ES. Is this still? Oh, it's on RTH. So I front ran it, seeing this breakdown as the possible high. So I was in about here. So that is just slightly in profit. I don't like this rounded top. I feel like this could get blown out. But again, it doesn't have to, and this could be the start of something massive. But it wouldn't surprise me if this is being treated as an entire consolidation and NFP was a manipulation start. We run out the highs and then go. But if we get up to 77.10, I am shorting as much as I can. Right now, I'm going to let this micro ES that I'm short play out. I'm going to let the options I have play out for the end of June, and we'll see where we go. But targets all to the downside on the indices. As far as where we can get in here, honestly, I don't know for this week, because this kind of imbalance, when it's left like this, you can gap down and continue, and then you'll have just this sharp, you know, radical rebalancing rally that everyone's like, oh, that was just a temporary whatever, buy the dip and go. And maybe that's going to become the narrative, buy the dip and go, and then it rips out these highs while NASDAQ and YM don't, right? Is it possible that we recover this entire candle, rip out these smooth highs on ES, and the NASDAQ and YM make a failure swing? Possible. Likely. I don't know. If this is the dealing range, that we haven't fully reached the potential target yet, and we have closed right at the 75 mark, right at the bottom of these bodies, I don't see it as impossible that ES makes a complete recovery run to just wipe all this out. Everyone's like, yeah, we're going down, sell, sell, sell. Wipe those people out and then down, right? That's often, from the 25% mark, is where the final liquidation of the dealing range and establishing the top, that impetus comes from the top quadrant of the dealing range. So this may not have been enough, and this was a strong showing that we are going down long term. However, we could launch back from here and then take all this liquidity and then start the real tumble. But again, this was significant enough that I'm only going to be looking for shorts. If I get wiped out a couple times, if it is recovering here, I'm willing to accept that to get a higher short price up here. Otherwise, if I'm looking short and it wants to continue, I'm on side. So in almost any respect, you're going to lose a few times if it does nail the top here again and then go down, or, you know, vice versa. Just instead of trying to play with ES, just short NQ, right? If you get a retracement back into a premium of this leg, by all means, short it, right? So if you've got this, well, okay, we've got this micro dealing range here. So into premium is 29,744, which is right into this buy side imbalance. So again, where do we get in? It's sort of a close your eyes and sell at any point. But if we are to get a rally back into premium, here's 29,744, which is right at this imbalance. So that would be the 50% mark where we'd tap the bodies of this, probably maybe even wick this candle, right? So 4-hour basis, if the indices show any willingness to recover at all, I'd want to see it hit premium. Again, it does not have to. If this is going to be as heavy as we anticipate it to be and dollar runs like we anticipate dollar to run, then we may not get a retracement. But if we do get a retracement on euro, on pound, on, and oil comes down a bit to allow for this, and dollar comes down a bit to allow for a brief rally. If we want to look at a head and shoulders, right, we have a shoulder, we have the head, and then we'd have another shoulder, which would line up right here at the 50% mark. So I wouldn't expect it to get all the way back up to 75 here in super premium. So 50% would be good enough for me to short that, or at least buy some puts on the QQQs or something where you can limit your risk to the upside. I mean, NQ itself, massive contract, and it's unlikely that many of us looking at this can hold an NQ. Even a micro, if it were to run from back here all the way up to the top, you're going to be out several $1,000s, I think. So again, it's not impossible, but I would love to be short back here at the 29,740 level for a massive rundown. ES, by the same token, this gap which we ran through, if we want to run a little dealing range here, this equal highs. Did not want to see that. Okay, 50% of that would be right here to this area, but if we did wick this candle, then that would be even more reason to get short, and I don't think we end up getting back into this imbalance, which we should have been leaving a balanced price range here with this dump out of this zone. So again, this super premium here, we launched off from the 25% mark, so that's super premium, and I doubt we're getting anywhere close to back to that. It's possible again that this is so bearish that we just hit maybe even the lowest quadrant of this last dealing range run up to the highs, and then we're down. We could also just gap through this, right? Because this is the 75%, this is the super premium launching point of the entire dealing range. So we could just gap through that, which I would consider as displacement, and just run. So, on ES, these are the three most likely scenarios. This would be the highest I'd want to see it retrace. We could just gap down and go. We could get a light retracement to, the bottom portion of this last run up, and then take another dump. Again, the most unlikely scenario is that ES wants to clear out these relative highs and liquidate and then come down, while NASDAQ and ES make a failure swing, because they both did have at least some kind of liquidity grab here that wasn't as smooth. So I don't see NQ getting all the way back up to our projected top there. And YM, this is pretty nice to see from a distribution standpoint, where you have a top and then a liquidation of that and a rundown. So this nice balanced price range. YM is pretty clean for me on the short side, if this is the dealing range, and we took off from the 75 again. So if there is to be any recovery, just anywhere here in the little premium zone would be fine to take a short. And micro Dow is not unmanageable here. So if you were to short a couple contracts micro Dow for a long hold, that could be your ticket, right? This high might get a corollary on this side, and then this one. So we might just see, like a 5-hump camel here or something, where we've got 1, 2, 3, 4, 5 and down. Unlikely. I think we just see one more little run up, because once this starts, it really doesn't want to stop. I think people are ready to get out of their positions. The final liquidity has been taken. The volume is high coming down off of this. So again, we've had little volume humps on the way up, and then boom, we had the big volume to finish it off on Friday. So if we get any sort of retracement, I would just look into a little bit of premium of this last dealing range here for a long-term hold to the downside. I'd say till October, November most likely is going to put us, for the Dow, like way down. 43,000, that's that dealing range. If you project 4 standards, you're at 44,000, which liquidates this low, which I'd expect. Honestly, I see a lot lower for Dow. We have this imbalance down here that we haven't touched since this candle from a year ago or 10 months ago. So again, on all the indices, I'm not bullish at all. I haven't been bullish at all since the beginning of the year, but I saw the run down in March. I thought we're going to liquidate that. It wouldn't be surprising to liquidate those highs, and now we're coming for it. Bitcoin, it did nothing but flush last week, which is one of the scenarios we outlined. We did not even get a push to premium or super premium, right? Like we hoped. Again, I wanted to see this and I'd be extra short up here. This was fiddling in the middle, but if you were already short, great, right? Initiating a new short here was a bit risky. You have this possibility up here, but if your risk tolerance is such that you wanted to follow this analysis and just be short from the open, it paid off. This was certainly in play and we nailed it. So Bitcoin was completely a bear all week, and in my opinion will continue to be a bear at least down to 40, basically 50,000 or less, right? Our target 49,960 here would be this low, and it should liquidate this low from back in August of 24. So a 2-year cycle to get us all the way through this market maker sell model to here. Now, again, as we discussed on Bitcoin, if it really wants to be aggressively bearish, this consolidation is not out of the question, and we could be seeing 25,000 in no time if the liquidations just continue. So again, we were bearish. We wanted to see some return to premium, and it did, and it came back, and we just completely blasted through, right? So our initial aim of this dealing range, where there are flat lows here with an imbalance between, right? That 25% mark, the super discount, was where we took off from here. So this is the next logical target, 49,960, with a possible consolidation here and a rip down to 25,000 is possible. We are out of this scenario where we will try to take more on the buy side liquidity. So on the weekly basis, we just flushed, and we could very well continue to do so. We might tap the top or the bottom of this range, right, before we continue to the downside, at least to here, 49,960. This low will get taken, so actually I had that in the right place. We will go below this low almost assuredly, and possibly lower, right? If we take one standard deviation from this entire dealing range, that puts us at 37.1, which clears out these lows, and there's no imbalance there yet. So, you know, we could, if we take this parent dealing range, we're at 22,000, which takes out these lows. So again, Bitcoin ultra bearish, have been since here, have taken 1 or 2 positions in it. Again, I like analyzing it and kind of trolling the people that were long Bitcoin or perma-long Bitcoins, perma-bull Bitcoins. I'm sorry, it's just not there. And last week, you know, I said I hope I didn't offend too many Bitcoin bulls, but you can see what's happening. We've displaced through this entire consolidation, and we're headed to at least the super discount, if not a complete liquidation and finishing of this market maker sell model. So how fast it happens, I don't know. If we do get a retracement, like we're saying we could for the other indices and euro and pound, for example, we might be able to get back up here to the bottom of the range, which would be the 25% of this dealing range. So that's a logical place to be, again, looking for shorts where we're not going to get too deep into this premium here. On a weekly basis, you know, that could be a day or 2 or 3 to actually come up here, and then maybe with CPI on Thursday, we initiate the next leg down. Do we just gap down and keep going? Possible, right? We may not get these retracements that I'm talking about, and I'm just hoping we do, to provide a logical entry point for those of us that aren't already short or haven't, you know, don't want to miss the entire boat. We can catch up with a dinghy and get out to the cruise ship that's just headed to the downside on all of these things. So I am hoping that we get some kind of a relief rally in most of these assets to enable a reshorting, and this is a logical point right at the base of this consolidation for the Bitcoin short to continue. And while, you know, that's half the leg here, you can get another half here down to liquidate this low. So, you know, trading comes with ins and outs, and you're going to be in the market sometimes, you're going to be out of the market sometimes, but I always say a missed trade is better than a loss. However, if it's a calculated loss, taking a calculated position on an asset that you're that your analysis is playing out. Like I never should have let myself get scared out of euro, right? My analysis on euro was that this high certainly, but this high was still going to hold, and it did, and I was scared out right here at that green candle, and I regret it, of course, right? I mean, that 6E short that I had is worth several $1,000s now if I just left it open. But is it out of the question for me to get back in? No. Is it riskier? Of course, right? I have to now assess where I want to be putting a stop here, and above the weekly high is a logical place. Above 2 weeks ago high that's in this imbalance, another logical place, right? And I have to decide if I can stomach that risk on a futures contract or if I need to take it with a CFD broker and decrease my leverage. Even though it's a cheap trade, I still got scared out of it, and that happens. That's what the market does. But had I just had the conviction to go with the analysis I had, and had I started YouTube sooner, I probably would have still been in it, because I am finding that these are great ways for me to find conviction in my analysis and be able to hold trades much longer than I have been in the past. So I do want to thank you guys for being an audience to that, and that's one of the reasons I started this channel, was to help folks out that have their analyses and maybe want corroboration, or like me, I have these great analyses most of the time and I completely miss it or shortchange the trade. Like this one, I was in the euro and I completely got out, barely in profit at all, and it shook me out. Soybeans, however, I was able to capture at least half of this move, which I was pleased with, but it's still going, and my ultimate target was down here, as we've outlined for a couple weeks. Do I hold it that long? I don't know, right? That's always the tricky part. Are you willing to stomach a 30, 50, 80% retracement of what was an opportunity for profit this far, right? And oftentimes for me, I will get out earlier, expecting to be able to re-enter if it comes back, and if it doesn't, it doesn't. I'd rather, a bird in the hand better than two in the bush. Yes, some of you will say, well, then you don't really have your system documented and whatnot. Well, you know what? Partials always pay. So if you take a partial for 1,000 and you're trying to squeak out the next 1,000 and you lose half of that in the process, that's, to me, not a worthwhile risk or gamble to take, right? I mean, if you're already that far in profit and you can lock it in, and you're going to maybe miss the next extension to 10, 20%, 30% more than you had, that's to each their own, I suppose. Similarly, on the indices, right, I was willing to liquidate in February here, and if this were to continue, I would be sitting pretty. If it did what I expected it might do, which would be to completely run this whole range out, I'm only missing, on the grand scheme of things, an 8 to 10% move to the upside. Maybe in this case it's a bit more, 20%, but would I know that this is the top then? No. As it plays out, am I very confident that this is now a 5-year top? Yes. So, running these, I was willing to, and my daughter's going to college soon, so me risking this being the continuation to the downside was not worth it for me to, get a little bit of extra money in her college account here to have it potentially reverse anywhere in here. This I was willing to sacrifice and lock it in here. So again, it depends on your status in life, your situation, your risk tolerance, and what you have going on. If you're 20 something, you can afford to stay invested in stocks much longer and ride a 50% decrease and then a return. For me, I'm mid 40s. I can't afford to have a 50% downturn in stocks, even though, in the last 5 years, I've really come to analyze the markets more and understand technically where they're likely to go. Like this week's high is a very nice target for me. I'm just seeing that right now. 3 standards down puts us right at that level, right in this imbalance, clearing out equal lows. So minimum target for NASDAQ, 22,115 market now. For my daughter's college fund, I'd rather lock in, say, 80% of when I invested for her to here and have it not downturn for the last 3 years before she goes and miss this little last leg, assuming that's going to reverse anyway. So, why squeeze out the last 3 drops of lemon juice from the lemon when you've basically eaten the whole thing here? So that's my perspective on taking profits when you have them and not necessarily needing to shoot for the full target. Even if I'd run my stops up to here, sure, I could have just run some stops up here, but I don't tend to have stops in for longer term investment holds like a college fund. So liquidating most of my positions here in my wife's retirement account here made sense. And now I am liquidating everything else. What do we put it in? I actually don't know. I would have said gold, but gold at this point looks as bearish and as correlated with the indices as anything else. So what do we put it in? That's a question that remains in my mind, and it may become clearer as certain charts as certain charts find support or resistance at other levels. Maybe we do put it in to the euro, the yen. Who knows? I don't think it's Bitcoin. I don't think it's the dollar. Swiss franc, Canadian dollar. I don't know, but we can look at those charts another time. But what do we put it in? I don't know yet. It doesn't look like anything right now except oil and the dollar. And the dollar only for the short term. I don't see the dollar taking out its recent 5-year highs. Again, this high looks like it's going to be the 5-year high, because this high looks like it was going to be the longer term high when this on the annual basis did not, the bodies closed below this 25% mark. Again, on the annual basis, right? So this is like from 2001, so 20-year basis, this was the high, and these bodies could not close above that super premium zone. We had a wick, we had a body close at the super premium zone, and even within this zone, the body is at the turtle soup level of 0.886, and then we broke down below these lows. So again, dollar I don't see as the long-term store of any value. I think, with as much has been printed and the hegemony of the U.S. kind of waning, the dollar is not going to be a reserve currency. So I'm hoping what I see is as the dollar gets up here, gold gets as low as it can possibly get, and then it starts to turn around and will become the, again, safe haven store of value, as technically it should and has been for the last 5,000 years. And that might make sense, where there's been this huge run up in gold to get everyone excited. Everyone bought in, right? They're all like, oh, gold's not going to stop. They bought in, and on a 12-month basis here, I'm going to just hide the drawings. If we are to come back and get to the top of this red candle here, where if this is an order block to accelerate us up, it could take, a year or two. I mean, this was 1 year. If we come down this year, and then the start of 2027, we can kind of wick down here. I don't know that we get that low. This is a propulsion block, it looks like, right? So if you study ICT, this is a propulsion block, and we may not actually get there. If we are to take this dealing range, all the drawings are going to come up. Right, I already drew that one. So a super discount is 26.29, liquidating this year's candle. So that could be a complete rebalance of this year's candle, which would be an immediate rebalance and then a shot for the moon. And if even if we get just to a 382 level here, so a 618 retracement of this last year, that could be good enough, and we leave a gap here for a major run to the upside. So if gold is inversely correlated with the dollar, at least for the short term, and is able to come down, then maybe it does become more of the obvious store of value in case of dollar losing its status as reserve currency. What else is there? There's possibility of the emergence of a BRICS basket of currencies, and again, that it's not going to be anytime super soon, but it's something to keep in mind. Where is the opportunity once the dollar peaks out and is ready to give up its status? Is it going to be gold, silver? I'm kind of hoping that it is, with a run back down here into discount. It might just hit the 50% mark, 36.29. So we'll see. We'll see where and if gold and silver might bottom out here at the 618, at the 50%. If it wants to liquidate last year's low, that might be the case. For a 2 standard deviation down from this range, we might wick into it at the beginning of 27 and head up. So I'm hoping that it ends up being gold or silver and metals, as it has been for such a long time, and we'll see where on this last year's candle rebalancing that might occur. Otherwise, I don't have an answer for you on what is a good replacement for the US dollar as the reserve currency and what does the world move towards, but I don't see the dollar making any all-time highs soon and stalling out here in the next few months. So that does it for this week. I know there's a lot happening with NFP this Friday, and it made a lot of analyses a lot more dire or clear in certain cases, and thanks for sticking with me. I know it's a long one, but a lot's happened and it's worth discussing. So cheers, stay safe, trade well, and we'll see you in the next one. That's why I do these videos, so that if you're seeing something that aligns with our analyses here and you can catch a monster move like there was with NFP delivering with a bang, then that's what I'm here for. So my analysis may play out completely without me, as I said in my first intro video, that I often analyze the market correctly, and if that can help you, great. I follow a lot of markets, but it doesn't mean I catch every trade. That's how the markets move. So you got to pay attention to assets that you're keen on, keep dialing in there.